Hello everyone, Professor Christensen here. This quick video is going to be an introduction to depreciation, and we're going to take a look at straight line depreciation. So here I just want to talk about, first of all, what it is. And in accounting, depreciation is different than in real life. We call it real life. So for example, if you say your car has depreciated, what does that mean? Depreciation in real life is a loss in value, right? Now, depreciation in accounting is not a loss in value, so you have to put that out of your head. And a lot of students have a very hard time with this. Depreciation in accounting is allocating the cost over its useful life. Or let's just say over an asset's useful life. Okay, so depreciation in real life, you say something depreciated, that means it went down in value. In accounting, you are allocating the cost of an asset over its useful life. So let's see how this works. Your successful landscaping business needs a new truck, and you buy it on January 1st for $50,000, signing a 5-year note. You estimate the truck will last 5 years. So that's called the estimated useful life, 5 years. All right, so let's make the journal entry to buy the truck. So to buy the truck, we're going to debit equipment, or you might debit truck. And that's going to be for $50,000. And then we're going to credit note payable for $50,000 because we have not paid for the truck yet. Okay, so now we want to find out our annual depreciation. Now remember, so what we want to do is we want to allocate the cost of this asset over its useful life. Why? Because we have a $50,000 asset sitting there. We're going to use this equipment to earn revenue, right? So remember that we want to match expenses with revenue. We want to record expenses in the same period as revenue. So we're going to take 1/5 of this as an expense each year. So our annual depreciation is equal to cost, and you might have a salvage or residual value. I'll put these in parentheses. Cost minus salvage divided by useful life. Okay, so we don't have any salvage value here. A salvage or residual value would be how much the truck would be worth at the end of its useful life, but we don't have that here. So we're assuming the salvage is 0, and at the end of 5 years, the truck is not going to be not going to have value anymore. So we're going to take our $50,000 and we're going to divide it by our useful life, and that gives us $10,000 annual depreciation. Okay, so each year we're going to record $10,000 in depreciation. Now, depreciation happens at the end of an accounting period. It is an adjusting entry, and if you remember adjusting entries, they always affect one balance sheet account and one income statement account. So we're going to debit depreciation expense for $10,000. And we're going to credit an account called accumulated depreciation for $10,000. Now, accumulated depreciation is a contra asset account. Okay, let's put a little star here. So we know that accumulated depreciation is a contra asset account. If something is contra, that means it goes against. So contra asset means it goes against the asset. So let's see what that looks like. So each year, so book value of an asset is equal to, let's put a double star here so we can say what book value is equal to. Book value, again, I know this can be a little frustrating, but book value in accounting is not the same as book value of your car, right? You can go and look up a book value of your car. Book value in accounting is equal to cost, the original cost, minus accumulated depreciation to date. And each year, the accumulated depreciation goes up and the book value goes down. So the cost of our asset is equal to book value is equal to original cost minus accumulated depreciation. And that's going to give us book value. All right, so our original cost is not going to change, right? Every year our original cost is the same. It cost us $50,000. What's going to change every year is accumulated depreciation. So accumulated depreciation in our first year is $10,000, and that means our book value is $40,000, right? Accumulated depreciation $10,000, book value $40,000. All right, now every year, like I said, our accumulated depreciation goes up. So in the next year, we're going to add another $10,000, and our accumulated depreciation is going to be $20,000, and our book value is going to be $30,000. Okay, and again, we're going to go all the way through. Next year, our accumulated depreciation goes up again by $30,000. Now our book value is down to $20,000, and $40,000 is our accumulated depreciation in the fourth year. Our book value is down to $10,000, and then in the final year, our asset is what we would call a fully depreciated, and its book value is 0. Now, if you had a salvage value, let's just make a note here. At the end of the asset's life, book value equals salvage value or residual. Now, in this case, salvage or residual was 0, but say you had a $5,000 residual value. Make sure that when you get to the end of its useful life, that number is showing up here. Okay? All right, so what goes on the income statement? Every year, depreciation expense of $10,000. Whoops, $10,000 for 5 years. All right, what goes on our balance sheet? This is what goes on our balance sheet, right? And so this is going to be long-term asset, or it might be called property, plant, and equipment. Okay. And this is the number. Now, if you look at the financial statements of a large company, you're probably just going to see this number here. And it would just be called equipment, net. All right, so that's the same thing. They're just not showing you the details, and they'll show you the details in the footnotes. All right, well, I hope that little introduction to depreciation helps. And if you are enjoying my videos, please subscribe to my channel, and I'll see you next time.